Hey, what's up everybody? Welcome to Ala's World of Finance. In this quick video, we're going to talk about dividends and we're going to explain what they are and how they work. If you're new to the channel, please subscribe because I do free videos where I explain things about the stock market and I break stocks down. And if you like the video, please like the video. All right, let's go ahead and get started. Now, when looking at dividends, let's define what a dividend is. It's a payment made by a corporation to its shareholders. So if you own stock in a dividend company, they will actually pay you money just to own stock in their company. Now, these payments can be made in one of two different ways. There are cash dividends and stock dividends. Cash dividends are payments made in cash, and then stock dividends are payments made in extra stock. So the company will actually give you more shares of their company. I mostly see cash dividends, to be honest. So just for your reference. Now, why would companies want to offer dividends? Well, there are advantages. In fact, dividends attract investors. This is because it offers an extra steady source of income. So you can basically make another source of passive income just by owning stock and leaving it there in the company, and you'll get money for that. It also is a sign of the company's strength, because if a company is offering dividends, that could be a sign that the company has a positive outlook on their future earnings. Now, there are exceptions to this because sometimes a company may be struggling, and so they'll offer dividends to attract investors and keep people invested in the company. And then later on, they could actually be doing poorly and stock could go down. So you really have to do your research and make sure that you like the company before you invest in it. And I'll talk a little more about that later. Now, the payments, let's do an example to demonstrate how the payments work. So in this example, a company pays $1 per share annually, okay? Now, most companies pay out quarterly. So in this example, there are 4 quarters in a year, and the company will pay you 25 cents per share per quarter, and that'll add up to $1. But obviously these numbers can fluctuate. This is just a very simple example of how it could work. Now, are dividends taxed? Yes, they are taxed. However, there are different rules for different accounts, so you have to do your research on what type of account you have. For example, retirement accounts and things like that. They may work a little differently, so you should just talk to whoever is handling your account. Now, let's go over some of the terms. So there's dividend yield, which is the dividend per share, so how much they're paying per share, divided by the price per share, or how much that stock is worth in the market. And then that gives you a percentage, and so it's usually represented as a percentage, and that's the dividend yield. Now, dividend payout ratio is a little different because it is how much of a company's net earnings are paid out as dividends. And investors will look at this a lot because, you know, some people like dividends and some people actually hate dividends, because if a company is paying out dividends, that's less money that they're reinvesting into the company. So some investors would prefer that the company just reinvest that money into the company for future growth and things like that. So a lot of people will pay attention to the dividend payout ratio and see how much the company is spending on dividends. Now, let's look at the ex-dividend date. So the ex-dividend date is the date by which you need to own the stock to be eligible for their dividends. So if you want dividends for a certain stock, you have to own that stock by the ex-dividend date. Now, you can sell that stock on or after the ex-dividend date. You don't need to have it through the record or the payout date. You just need to have it by the ex-dividend date. Now, the record date is the date in which the company evaluates who is eligible for dividends. And then that leads to the payout date, which is the date when the company makes dividend payments. Okay, so let's give an example here of a dividend kind of playing out. So in Apple's last earnings call, they announced that they were increasing their dividends because they're doing well and they have a positive outlook. So they increased their dividends. Now, their ex-dividend date was May 11th. So in my example, because I actually own stock in Apple, I had to own that stock by May 11th, which I did. And then on the record date, they evaluated and they saw that I had the stock by the ex-dividend date. And then the payout date was on May 18th, and I actually do have my dividend money already paid out to me. And then the dividend yield as of May 19th is 1.53%. That can obviously fluctuate because, you know, stocks value in the market can change, at any moment. And for that quarter, they were paying 63 cents per share. So I got 63 cents per share of my Apple stock. I think that pretty much covers everything. If you guys have any questions, please leave a comment below and I'll be sure to answer it. Thank you so much for watching and have a wonderful, beautiful day. Take care.